one thing is for sure, be warned, it might not be as easy as you think, and there are plenty of potential tax traps for the unwitting.
Hello there. As a tax barrister and chartered tax advisor, I've advised many clients who've been looking to move abroad. And at the moment, leaving the UK it seems to be a bit of a hot topic and something that I'm frequently asked about. So what I plan to do in this video is to break down what you need to know using a bit of a case study, really involving a UK entrepreneur who is looking to relocate to Dubai. But one thing is for sure, be warned, it might not be as easy as you think, and there are plenty of potential tax traps for the unwitting. So in this video, I don't propose to tell you why. It's not for me to tell you why you might want to leave the UK. You may not want to leave at all. That's fine and dandy. I have no interest in persuading anybody to move to Dubai, Dubrovnik or Dublin. I'd be just as equally delighted for you to decide to stay in Duckenfield, to be absolutely blunt. However, this video is really about the how. For those who want to relocate, how they might do effectively for tax purposes, how they may get out of the clutches of the UK tax net. Importantly is that we, and if we want to, we stay out of the UK tax net. So in the case study, I am going to look at Dubai because it is a popular destination, but I'm not a travel agent, I'm not on commission, so I am using it as an example. Okay, let's crack on. Before you make the leap, you need a plan. So first of all, we need to research our destination, and I don't just mean taxes. We need to look at the cost of living, culture, career prospects if we're still working, and really make sure the place that we're upping sticks to and putting our sticks back down again fits our lifestyle and meets our expectations. It's then a case of getting your financial house in order. We need to understand the tax implications of leaving the UK, including any potential pitfalls that we might encounter. It goes without saying, quick plug for myself, is a proper tax advisor comes in handy during this part. Don't overlook the practicalities, the visas, the housing, healthcare, schools. All of those things are going to be crucial if you want to make the transition as smooth as possible. As a qualified tax advisor like myself, there are many good ones out there. We can help you with most of that, and it may well be that for some of those other things that I've just mentioned, you can tap into their expertise and network to find some good advice in those other areas as well. So enough of the preamble, let's bring in our case study and see how the tax implications pan out in the real world. Our main protagonist is called affectionately Jimmy the Glass. Now that's not because he's some kind of 60s London East End gangster. Instead, he got the name because he's the brains behind the second most successful double glazing company in the UK, thanks in part to some unforgettable TV ads with a famous soap star. Business is booming, continues to boom, and he's got a number of offers on the table that could net him a cool £10 million for the sale of the business. Sadly, in Jimmy's case, he's feeling the weight of the UK's tax burden firmly up on his shoulders. He's one of these people with the big broad shoulders that the government is so fond of targeting. He's also, importantly, tired of the dreary weather, the political wrangling, and also a sense that, well, he fancies a bit of an adventure. He might be able to enjoy a lifestyle elsewhere. So Dubai, with its sunshine, what he sees as its business opportunities, and let's face it, generally lower taxes, is looking pretty tempting to Jimbo. So he's spent quite a bit of time there in the past, wheeling and dealing in the building trade. He's a man of many talents, and he likes what he sees. It's a place he's familiar with and thinks he will enjoy living. So his train of thought is he's thinking of packing up his family and making the move by the 6th of April 2025. But before he throws his brolly in a dustbin and grabs his Ray-Bans, let's see how his taxes might change. Jimmy is currently UK resident and UK domiciled, which means basically he will pay UK taxes on his worldwide income and gains. Ouch. There is a thing called the remittance basis, which can sometimes offer a bit of a tax break for those who are UK resident but not domiciled here. However, firstly, that's not Jimmy's situation, and secondly, the remittance basis is something that, as things stand, although we haven't seen the formal legislation, is something that's going to be removed from the 6th of April next year. Anyway, so we're not going to trouble ourselves too much with that today, or indeed at all. So the big question is, what is the benefit of him becoming non-UK resident from a tax point of view? So the effect of being non-UK resident for tax purposes. What is this Shangri-La? Well, if we're non-resident for a period, what's the big deal? Well, quite simply, our tax position shifts. Our exposure to UK capital gains tax will disappear, except on direct and indirect sales of UK real estate. Importantly, that is padded out by the issue of the 5-year temporary non-residence, or, because I'm down with the kids, I call it the Deadpool rule, but we'll talk about that shortly. That's one of those pitfalls that I mentioned earlier in the piece. A non-UK resident will only pay tax on their UK source income, but quite remarkably, this does not include dividends from UK companies. So despite the fact the UK company is pumping it out and it would be UK source, there are specific rules in the legislation which disregards that income for a non-resident person. So that's quite cool as well. But we need to be careful, because there is another of those 5-year Deadpool rules which applies, although that is much more limited. So this is a good place just now to talk about that 5-year non-residence or Deadpool rule. And as I said, as a non-resident, the position is that there is no UK capital gains tax other than on UK real estate, and UK income, excluding UK dividends and some other UK income. So for CGT purposes, a simple wheeze emerges. So let's say Jimmy has a number of offers for his business, somebody wants to come in buy the shares. He makes himself non-resident for the period in which he sells the business, and Bob's your uncle, a tax-free disposal, just like that. Clearly, he could then come back within the space of a couple of years, and he's elegantly avoided tax on that gain. But this is where our 5-year anti-hero comes in to play. Yes, fine, Jimmy can sell the shares when non-resident, as described. He won't pay tax if he is non-resident in that year. However, if Jimmy's stay, his total stay outside of the UK, does not extend to 5 complete tax years, then the gain will resurrect itself, like Deadpool, and be taxable when he returns. So if his stay outside of the UK is not over 5 complete tax years, then the gain will recrystallize when he returns to the UK. So it will come back and bite him on the backside. Importantly, this rule only applies to the assets he owns at the time he left the UK. So if Jimmy buys some off-plan properties while he's living in the UAE, those can never be caught by this 5-year rule. A similar rule does apply to income, but it's very limited in scope. For example, if Jimmy doesn't sell his UK company, he receives dividends from the company, and those dividends actually relate to profits that arose in the company whilst he was still resident in the UK, then that income will again resurrect itself under the Deadpool rule. So quite a tricky little rule as well, but pretty narrow in scope. It is perhaps stating the bleeding obvious that 5 years is a long time to stay outside the UK, and it will be this rule that may scupper the plans of many people who are using non-residents of a means of, say, circumventing capital gains tax on valuable assets, particularly on business sales. But you need to be aware, and it's essential that you get proper advice in this area before you do anything too dramatic. So where are we now? Well, Jimmy's planning his move to the UAE. He's getting ready to make the move to Dubai. Where in Dubai? We don't know. We don't really care that much. But before he does go, he needs to think carefully about his residence position, and more specifically, how he breaks his UK residence. So he needs to think very carefully. So we need to think very carefully about Jimmy's tax residence if we're advising him, of course. So let's look at it in a strict back fashion and assume he goes to the UAE as either an employee of a third party or an employee of his own company. So he sets up a company in the UAE and becomes a director. The general position around residence is that a person is UK resident for an entire year or not. So it's binary. You're either resident or you're not for the complete tax year. But we will see this might not always be the case. So park that thought and we'll come back to it in a minute. But to determine whether someone is resident for a period or not, we have something called the statutory residence test, which gives us quite a mechanical process for ascertaining somebody's residence position. So the first step is we start, and it's basically a series of tests. And it's like a waterfall. You look at the first set of tests. If you satisfy it, you don't have to look any further. If you don't, you fall down a level. And if you satisfy one of those, you don't go any further. If not, you go down to the next. So we start at step 1, the first series of tests. And that is to determine whether any of the automatic non-UK tests apply. If they do, as I say, we stop there. And you are non-UK resident for the year. If not, you move on to step 2. Step 2 is the automatic non-UK test. So the automatic UK tests. God, I'm going to have to get this right, aren't I? So step 2, automatic UK tests. If we satisfy one of those tests, then quelle surprise, we are automatically UK resident for that year. If not, we move on to the third and final stage, which is the sufficient ties tests. And under step 3, the sufficient ties test involves looking at what ties the person has to the UK. So family, accommodation, work ties. And the more ties that one has with the UK, then the less time you can spend in the UK without becoming a resident there. So, as you can probably see, locking in your non-residence at step 1, so getting a big tick in the box in one of those automatically non-UK resident tests, is pretty helpful. So might this be possible for Jimmy? Well, I think probably it is, because broadly speaking, if Jimmy goes to the UAE to work, either for a third party or even as a formal director of his own company under a full-time, so in both scenarios under a full-time contract, then he should satisfy one of those step 1 tests, as it were. But he will need to work full-time for the year. He will need to spend no more than 90 days in the UK for the year. He'll need to limit his UK work days to 30 days or less. And when his UK work day will be, broadly speaking, when he's back in the UK, and a work day's essentially working more than 3 hours. So he'll need to manage not only the days he spends in the UK, but he'll just need to moderate how much work he does in the UK as well. So if Jimmy goes to the UAE on the 5th of April 2024 and he maintains satisfying those requirements I've just set out, then he should be non-resident for 2024, 2025, no sweat at all. But things, as I say, remember I asked you to hold the thought, and we could actually find ourselves in a slightly better position, and we'll look at that and split year treatment next. So, as I said earlier, I asked you to park a thought for me. Remember, I said that you are either UK resident or not for a tax year. It was a binary choice. But what if I go in, September 2024, so this month, I guess halfway through the tax year, is Jimmy screwed from that perspective? Does he effectively have to wait really for the 6th of April before he can get that non-resident clock running? Well, that's a very, very good question. And actually, we don't have to wait because Jimmy, on the circumstances that we set out, is likely to qualify for something called split year treatment. And here we can slice and dice the tax year into 2 periods. So the year that we leave, so let's say it's the tax year 2024-25, we leave in September 2024. The period before that, he is UK resident. The period after, he is non-resident. So October, November, December, etc., he is non-resident for tax purposes. So this is obviously quite helpful because we may have a scenario where income before he moves in September is within the UK tax net, but income thereafter isn't because it falls into a period of non-residence. And and split year treatment will apply if somebody begins full-time work overseas where they would otherwise be UK resident for the tax year in question. They were UK resident in the previous tax year, and they are non-UK resident for the following complete tax year, so this tax 25-26, based on their full-time work status. And again, this is an important requirement I'm going to return to again in a minute, because this could be a rug. Although split year treatment is generally a really helpful thing, that final requirement is a rug that could very swiftly be pulled from under your feet, and this is potentially an issue for some very high profile individuals. But the effect of slicing and dicing means that from the moment you take up your job overseas, Jimmy's case UAE, to the moment that they come back, they're going to be considered non-resident. So potentially anything that plops in income or gains into that period, subject to those anti-avoidance rules I've mentioned, potentially could escape the UK tax net. In other words, does what it says on the tin. The tax year is split in two. But as I said, split year, it's also a trap. You remember, I tried my best. I tried my best to emphasize that third and final condition. It's been really important. So split year treatment can only apply if the person is non-UK resident for the following complete tax year. So if Jimmy goes in Sept 2024, we're talking about the 2025-2026 tax year, non-resident for that complete tax year based on their full-time working status. So in effect, it requires us to see into the future or rely on future events, which means we continually need to manage and maintain Jimmy's position. And obviously we can't see into the future, and SHIT does happen. So we'll be potentially treating ourselves on as being non-resident for a period on that split year basis, on the assumption that we will be non-resident for the entirety of the next tax year. So as you can probably guess, there's a huge potential issue if life gets in the way, we lose our job, or we have to return to the UK for some other reason, homesickness, parents getting ill, whatever. That will have an effect on not only our current and future status, but potentially on our previous one as well. And I've written an article recently on this in the context of footballers. So somebody like Jordan Henderson and Wilfried Zaha, they moved overseas, potentially with better tax outcomes, but those tax outcomes were potentially put in jeopardy by potential transfers back home to the UK, and I'll put a link to those articles in the comments below, because we don't want to get bogged down with the business of footballers. But the moral of the story really is you need to beware. This isn't just a process that is done and dusted at the beginning. You just need to keep an eye on it. You need to keep this at the forefront of your mind, that actually something you do a little bit further down the track could come back and bite you on the bottom. So in summary, locking in split year treatment is probably an attractive thing to do. It can effectively accelerate some of those lovely tax advantages of moving overseas by slicing and dicing a tax year in two. But as I say, it's something that you need to continually manage. Jimmy is in the UAE now, and he won't be returning to the UK anytime soon. But what is his inheritance tax position, good old IHT. Well, there's a lot of confusion amongst expats in this area. It's amazing how many expats I come across who are wholly misinformed about their continuing IHT exposure. At the moment, as legislation stands, UK inheritance tax is almost entirely based on the concept of domicile. So residence only has a very negligible impact on the position. As Jimmy is domiciled in the UK, then despite the fact he has moved to the UAE, he will be subject to inheritance tax on his worldwide assets. He could, if he had spent many years outside of the UK, assert that he is no longer domiciled in the UK, but that will not be straightforward. And secondly, the basis of inheritance tax in the UK is about to change. A huge change seems to be in play either from the 6th of April or not too long afterwards. And this was part of the changes to the taxation of domiciles, first announced by the Tory government. People seem to be conveniently forgetting that at the moment, but has been well and truly carried forward by the Labour Party since they came in. And we're told that going forward, we will move to inheritance tax that is a residence-based regime. So if you don't satisfy the residence-based test, whatever that will be, but let's say if you've been outside of the UK for 10 years, then you do not satisfy that test anymore, then the feeling is you will probably only be subject to UK IHT on your UK assets. Everyone will continue to pay inheritance tax on their UK assets, and if you satisfy the residence test, such that you tick that UK residence test box, then you will pay inheritance tax on worldwide assets. So the opportunity is, if you're a long-term non-resident of the UK, you may be able to escape IHT on overseas assets. And although we're yet to see draft legislation, this could be potentially quite attractive for expats, and there will be many expats watching these developments pretty closely. So in summary, bad news potentially for non-doms in the UK, who will find that their exposure to UK IHT is ratcheted up, and I think this is something that will potentially make a lot of people think, you know what, actually, can I conduct my business in the UK whilst being non-resident, which might lead to some people leaving the UK. But subject to what the final rules look like, it could be a great opportunity for long-term expats to have a bit more certainty, not trying to assert that they're non-domiciled, and potentially reduce their exposure when it comes to IHT. So there you have it. Leaving the UK would undoubtedly be a big decision for anyone, but as Jimmy's story shows, it's definitely possible to create that future overseas, but also managed properly, limit your exposure to UK taxes. So if you are ready to make that kind of leap, do your research and put in place a plan. I would suggest that you do that alongside professional advisors, Lots of excellent tax advisors out there, but with a wider network of advisors, somebody who can perhaps bring in visas and schooling and those kind of things as well. If you do need any help along the way, don't hesitate to reach out. I'm here to support you on every step of the way if you should wish. Thank you very much for watching right to the end. If you found the content helpful, give it a thumbs up. Please subscribe to my channel for more tax expat tips, and I'd love to hear your thoughts on leaving the UK or otherwise. Again, as I said at the outset of this, I'm not trying to persuade anybody at all to leave the UK. So if you're considering making a move or you've already made the move, please feel free to share your stories and insights in the comments below. But remember, the world is your oyster. Go out there and find your pearl.